Ever wondered how to make your money work wonders? Deep dive into the long-lost clip where investment guru Charlie Munger reveals his secrets to generating a staggering 50% annual return by investing small. Meet Charlie Munger, the investment genius riding shotgun with Warren Buffett at Berkshire Hathaway. Think of him as an unsung hero behind one of the world's most successful financial empires. Not just the Wall Street bigwig, Munger has had his hand in everything from newspapers in sunny Los Angeles to the aisles of your local Costco. While he might not be making headlines as much as Buffett, Munger's sharp insights and strategies have made him an icon in the finance world. Wanting on his secrets? Let's dive in. An old saying is often quoted, "It takes money to make money." While the authenticity of this saying is acknowledged by many, Charlie Munger challenges its depth. According to him, you don't need mountains of capital to start. Instead, it's about how smartly you play with what you have. When an eager audience member posed a query about generating high returns on small capitals, like $50 million at a rate of 50% annually, Munger's response was enlightening. It was highlighted by him that if you're chasing rapid riches with specifics, you're probably in the wrong room. Instead of handing out detailed steps, mystery should be left for everyone to uncover their path. Throughout his life, it was observed by Munger that only a few good ideas came his way, but the emphasis he placed on this was the value of these few. You don't need countless opportunities, just a handful of the right ones are required, and when they're encountered by you, aggressive action must be taken. He often recounted tales of his maternal grandfather, a pioneer, who faced intense hardships but ended up being the wealthiest man in his town. The journey wasn't filled with countless opportunities. It was just a few key moments, decisions to buy a few farms during economic panics that set his path to prosperity. Lessons from this tale can be extracted by all. Opportunities are rare, but they can be life-changing when acted upon correctly. Computers today, as was noted by Munger, can scan the entire globe for investment opportunities. It's akin to placer mining. However, these digital gold rushes are often short-lived. As soon as a niche is discovered by algorithms, it gets swarmed, reducing the profitability for all involved. Munger doesn't think much of this method. He likened those who leech off trades using computer algorithms to rats, saying their contributions to society is minimal at best. Making money through algorithmic leeching is not favored by Munger. He suggests that if wealth is acquired this way, a healthy portion of it should be given back to society as atonement. However, for everybody else, the journey of investing is bound to get tougher, and that's something that must be accepted. The core of Munger's philosophy: wealth generation isn't about numerous opportunities, but about recognizing and seizing a few golden ones that cross your path. When diving into Charlie Munger's secrets to sky-high returns, a vital piece of advice stands out: target inefficient markets. Now, here's a fun fact. Munger plays a pivotal role in Berkshire Hathaway, which, with a whopping market cap nearing $800 billion, ranks as the 9th largest global company and the top non-tech titan in the US. Impressive, right? You'd think that with such hefty financial muscle, their investment game would be unbeatable. Surprisingly, it's the opposite. Both Munger and his partner Warren have often stressed that their company's colossal size actually hinders their investment prowess. With so much money on the table, they find themselves chasing only the biggest of the big investment opportunities. But here's the twist: big doesn't necessarily mean profitable. These giant investments often come with slim chances of being mispriced or, in investment lingo, inefficient. In contrast, the smaller the investment, the higher likelihood of finding a lucrative inefficiency. So in Munger's book, going small could mean scoring bigger. Attention is focused on big investment opportunities by industry giants like Munger and Warren Buffett, leaving the smaller fish virtually unnoticed. That's where you come into play. Back in the day, thousands of hours were spent by Warren and Charlie poring over countless financial reports to discover one golden opportunity. Good news for you, the game has been changed by the internet. Gone are the days of tedious paperwork. With a simple stock screener, value mispriced stocks can be identified in no time. Another advantage is given by these smaller firms. They're often not on Wall Street's radar at all. Take Apple, for example. Every move made by the company is scrutinized by no less than 31 Wall Street analysts. In stark contrast, almost no one keeps tabs on these smaller companies. Consequently, the chances of finding a stock trading well below its true worth can be found by you are substantially higher. So, what's the takeaway? While big investors are confined by their enormity, you on the other hand have the flexibility and tools to tap into these ignored gold mines. And since they're not on anyone else's radar, the inefficiencies in these markets can be more easily exploited by you. Through this method, the secret to generating 50% annual returns with small investments, as recommended by Munger, can be cracked. When diving deep into Charlie Munger's wisdom, a golden nugget is to take significant action when the right opportunity presents itself. Think of it this way: excellent chances don't knock on your door every day, so when they do, it's time to go big or go home. For a clearer picture, let's borrow a page from the world of baseball. If you're not from the US, picture this. Baseball has two teams, one trying to hit a ball with a bat thrown by the other team with a ball. The objective, to hit that ball just right to score points. Munger believes this game has a thing or two to teach about stock investments. Let's delve into the story of Ted Williams, one of baseball's legends. He penned down his strategies in a book aptly titled The Science of Hitting. Inside, there's an interesting illustration. Williams at the bat, the strike zone divided into 77 boxes. His strategy, wait for the ball to hit his sweet spot, boosting his hit chances to 40%. On the flip side, an impatient swing might drop this to just 23 to 25%. The lesson? The best players can become just average if they swing at the wrong time and vice versa. Now, here's where it gets juicy for all budding investors. Munger champions the idea that this baseball strategy applies perfectly to investing. Imagine this: each day you're bombarded with thousands of potential investments. Visualize these as baseball pitchers. Success is all about patience. Keep that bat on your shoulder, scrutinize every pitch or investment opportunity, and only take a swing when it's smack in your sweet spot. But here's the kicker. The perfect investment pitches are like rare gems. You might find yourself waiting for what feels like forever, sometimes months or even years. But remember, the best things in life often require patience. So when that golden opportunity finally pitches your way, you've got to swing with everything you've got, aiming for those fences. Because in the grand game of investing, as in baseball, timing, patience, and a key eye for opportunity are all what differentiates the greats from the average. Ever heard of the age-old advice, don't put all your eggs in one basket? Well, Charlie Munger challenges that. Most folks will tell you to spread your investments wide, maybe across hundreds of stocks. Munger, however, calls this approach a bit misguided, especially if you're aiming for sky-high returns. Take a peek into his world. The bulk of his wealth tied up in just 3 main investments: Berkshire Hathaway stock, Costco stock, and a fund run by a certain investor named Lee Lu. Munger's strategy: zero in on one of a few stellar businesses, the ones that you've dissected inside and out. This deep understanding, he believes, positions you to make smarter decisions. And smarter decisions, they can pave the way for some truly impressive returns. Let's have a look at a story shared by Charlie Munger about his billionaire buddy, John Arriaga. You may think that Arriaga, with those big billion bucks, would have had his fingers in a ton of pies, right? Maybe owning a mix of businesses, holding a bunch of stocks, or heck, even a tiny island. But surprise, that wasn't his game at all. Here's a fun fact. Arriaga made his massive stash from real estate. Now, if you're imagining real estate, you might think about all sorts: snazzy apartments in New York, beach houses in Miami, or even self-storage units in Texas. And when you think about places, the US is just one option. There are about 387 real estate hotspots, or metropolitan statistical areas, as the jargon goes. And then, zoom in further, each of these areas has its own little neighborhoods, basically a smorgasbord of choices. Arriaga had a genius strategy. He only bought property near Stanford University in California. For 40 years, he'd buy when prices dropped and sell when they peaked, always careful with his money. It's like sticking to your favorite dish at a huge buffet, even if other options seem tempting. This focus made Arriaga super rich. Charlie Munger says it best: following the usual rules would have made me poorer. The lesson? Stick to what you know best, and it can be a jackpot. After unraveling Munger's golden insights, the question arises: what's your investment sweet spot? Share your thoughts in the comments below, and don't forget to like, share, and subscribe for more insights.